Howdy, Jacob here. Today we're looking at Avery Dennison Corporation in the containers and packaging industry. 18 billion market cap on 20 billion enterprise value. So a little bit of net debt, but nothing terribly concerning there. You're looking at a compound annual growth rate on revenue the last 10 years, maybe 2 to 4% here. You're not looking at a whole lot of growth. Pretty volatile as well, as high as 20% growth, but as low as -7% in the most recent year. From a gross margin standpoint, you're looking at high 20s, so not terrible there. And operating margin in the low double digit, 11 to 12% there. Good increase of earnings per share, quite a bit higher in their revenue. So that's a positive, meaning that their bottom line is increasing greater than the top line. They're becoming more efficient with the money that's coming in. And return on invested capital down a little bit, but we're still looking at averaging in the 12 to 13% range. So that's a pretty positive, very likely above their weighted average cost of capital, meaning that they're increasing and creating business through operating. Balance sheet shows 215 million cash on hand with 622 million short-term debt, 2.6 billion long-term debt. They do have quite a bit of debt here. And in relation to their free cash flow, let's look at how much that is. You're looking at about 3 billion in short-term, long-term debt, with maybe 600 million as the average of their 5-year average free cash flow. So that is about five years average of their 5-year average free cash flow could pay off their long-term and short-term debt if they used all 100% of that free cash flow to do it. So I mean, it is on the higher end of what I look for, but it's not so concerning that I would absolutely have to dampen it. But again, you'd have to take into consideration how risky you want your balance sheet to look in a company that you invest in based on the present value of earnings and free cash flow, not taking into consideration necessarily the balance sheet. So change your discount rate, maybe the terminal P and price to free cash flow to make you comfortable to invest in something that has 5 times their 5-year average free cash flow in debt. And their use of cash, if we look at the last 5 years, we do have quite a bit of acquisitions, and they've funded their large acquisitions through debt. So they haven't really, outside of the rolling 12, they haven't really reduced that debt figure. They've really just been more debt, more debt, more debt. But heavy investment through acquisition, a little bit on the reinvestment side, and quite a bit of share repurchases, quite a bit of dividends. So really all their uses of free cash flow they're utilizing. Their dividend is about 40 to 45% of their free cash flow. Their share repurchases are maybe 20%, acquisitions are probably 30%, and then reinvestment and debt reduction, the remaining whatever that was percent. And so a good amount being paid out in a dividend, you're looking at 1.5%. I question that based on I know they've been buying back shares. And when you buy back shares, it does inflate your return on invested capital by reducing the denominator that's calculated through ROIC. And so it makes your return on invested capital look larger than it is. And so when you look at return on assets, it's more along the lines of that 7 to 8% range. So not a terrible return on capital, but it's still a little bit surprising they're paying a lot to this. Maybe there's just not a lot of reinvestment opportunities for a company this large in the industry that they are in. And so then it would make sense to just buy back shares and pay a dividend. But they're also trying to grow that top line a bit, which we can see through acquisitions. It looks like their organic growth hasn't been too impressive based on the fact they've really only grown 2 to 4% a year over the last 10 years. And they've made enough acquisitions where it's likely due to that. But they have been pretty advantageous with those acquisitions, which we saw through increased margins on both the gross and operating margin side. Let's start making our assumptions here. On the revenue growth side, again, I don't think anything's going to be super sexy. I think 3% growth a year over the next 7 years, and then a PE, price free cash flow, that's a little bit lower than the market average. And they've been very consistent here. I might just be very consistent, say 7% across the board. 1% of shares would be about 182 million. And to offset stock-based compensation of about 200 million, which would be about 30 to 35% of their 5-year average free cash flow. I think I'm comfortable with that. Their dividend is currently paying out about 40%. I'm going to keep that the same. So then it reduces maybe to 30 to 35% at the end of 7 years. And I'm trying to create a little bit of opportunity for them to pay down some of that debt, maybe leave 20% of their free cash flow to pay down some of that debt. So this assumption is basically 30% roughly to share repurchases, 30% to dividend, maybe 20% to acquisitions, and then and reinvestment, 20% to debt reduction. I think that seems very appropriate to me, and based on what I'm seeing on this present value calculation, it needs to fall quite a bit before you get the return I'm looking for here. So interesting company, and nothing super sexy about it, but definitely interesting. One that I think could be a good investment at the right price. I mean, so could everything, but at this price, I just don't see it being super obvious, and I don't necessarily want to waste my time doing more research on something that's not a screaming deal. But I do hope you enjoy the video and have a great rest of your day.